Condos beat houses in 6 out of 10 key investment metrics. Here's the data. It's the most debated question in real estate investing. Condos or houses? Most people pick based on gut feeling. Lower entry price for condos, more control with houses. But gut feelings lose money. Data wins. We ran the numbers across 10 critical investment metrics: purchase price, rental yield, maintenance costs, appreciation rates, cash flow, management burden, liquidity, vacancy risk, leverage, and long-term wealth building. The results surprised us, and they'll probably surprise you too. The first metric is purchase price, and this one favors condos decisively. In the US, the median condo price in 2025 is approximately $310,000. The median single-family home sits at $435,000. That's a 40% premium for houses. In major cities, the gap widens further. A Manhattan condo averages $1.2 million. A comparable house in a similar walkable neighborhood would cost 2 to 3 times more, if you could find one at all. This price difference has enormous implications for investors. A lower entry price means lower initial capital requirement, easier financing qualification, and the ability to own multiple properties with the same capital. If you have $500,000 to invest, you can own one median house, or potentially 2 condos generating dual income streams. The leverage math alone makes condos compelling for investors who prioritize portfolio diversification. Condos win on purchase price. Rental yield is where the comparison gets genuinely interesting. Across U.S. markets, condos typically generate gross rental yields of 5 to 7%. Houses in the same cities average 4 to 6%. Why do condos yield more? 3 reasons. First, rent per square meter in urban condo buildings is higher than suburban houses because renters pay a premium for location, amenities, and walkability. Second, the entry price is lower, inflating the yield percentage. Third, condos attract a consistent tenant profile, young professionals and downsizers, who tend to stay longer and pay on time. In markets like Miami, Phoenix, and Austin, Class A condo buildings regularly deliver 6 to 8% gross yields. Comparable houses in those markets sit at 4 to 5%. The exception is in suburban markets, where single-family rental demand from families willing to pay premium prices for schools and space can push house yields to 7% or more. But in aggregate, condos have a slight yield advantage, approximately 0.5% higher nationally. Condos win on rental yield, narrowly. Maintenance costs are where many condo investors get blindsided. On the surface, condos appear cheaper to maintain. The HOA handles exterior repairs, landscaping, the roof, and common areas. Your responsibility is typically limited to the interior of your unit, but HOA fees can be punishing. The average U.S. condo HOA fee runs $300 to $600 per month, $3,600 to $7,200 annually. Special assessments, one-time charges for major repairs like elevator replacements or roof overhauls, can hit $5,000 to $30,000 with minimal warning. Houses, by contrast, require active management of all exterior and interior systems. The general rule of thumb is to budget 1 to 2% of the property value annually for maintenance. On a $435,000 house, that's $4,350 to $8,700 per year. But you have full control. No surprise assessment. No HOA board decisions. For investors, house maintenance is predictable. Condo maintenance has HOA risk. Houses win on maintenance control, but the dollar amounts are comparable. Capital appreciation is the metric where houses win, and the data is clear. Over the last 30 years, single-family homes in the U.S. have appreciated at an average annual rate of 5.4%. Condos have averaged 3.8%. That's a meaningful 1.6 percentage point gap compounded over decades. Why do houses appreciate faster? Land. When you buy a house, you own the land underneath it. Land is finite. Urban land in growing cities becomes more valuable as density increases. Condos, by contrast, are units in a building that depreciates over time. You own the airspace, not the dirt. In cities where new condo towers are constantly being built, supply can outpace demand and suppress appreciation. Houses in supply-constrained suburbs consistently outperform. There are exceptions. In hyperdense cities like NYC, San Francisco, or Singapore, luxury condos and trophy buildings have delivered exceptional appreciation, 7 to 10% annually, because the land underneath those buildings is irreplaceable. But across the national average, houses appreciate faster, build more equity, and deliver stronger long-term wealth accumulation. Houses win on capital appreciation. Cash flow is what determines whether your investment puts money in your pocket each month or drains it. And here, the picture is nuanced. Condos typically have higher gross rents relative to their price. We established that in the yield section. But after deducting HOA fees, the net cash flow picture changes dramatically. A condo generating $2,200 per month in rent with a $450 HOA fee nets $1,750 before mortgage and taxes. A comparable house renting for $1,900 per month with no HOA nets $1,900 before mortgage and taxes. After financing, the house often cash flows better because the full rent goes toward expenses without the HOA drag. In practice, investors who prioritize monthly cash flow often favor houses in suburban markets where purchase prices are lower, HOA fees don't exist, and family tenants commit to 2 to 3 year leases. However, investors in expensive urban markets, where house prices make cash flow impossible without 50% down payments, find condos to be the only viable path to positive cash flow. The verdict: houses win on cash flow when HOA fees are significant. It's market dependent. For passive investors, management burden matters enormously. And here, condos win decisively. A condo in a professionally managed building means the HOA handles all common area maintenance, building insurance, pest control, landscaping, and major structural repairs. Your day-to-day management burden is limited to the interior of your unit: appliances, flooring, fixtures. A house, by contrast, requires you to manage everything: roof, HVAC, plumbing, electrical, landscaping, pest control, gutters. For a landlord managing 10 houses, that's 10 separate roofs to maintain, 10 separate HVAC systems to service, 10 sets of exterior walls to paint. The operational complexity scales badly. For investors who want truly passive income, where they rarely get called, condos and well-run buildings with professional HOA management are significantly easier to own. The caveat: HOA quality varies wildly. A poorly managed HOA is worse than managing a house yourself. Due diligence on HOA financial reserves and management quality is essential before purchasing any condo. Condos win on management burden, assuming a quality HOA. Vacancy risk, the risk of your property sitting empty, is one of the most underestimated factors in real estate investment. And the two asset classes behave very differently here. Condos in urban markets with diverse tenant bases, young professionals, students, corporate tenants, and short-term renters, typically have vacancy rates of 3 to 5%. This means your unit sits empty for roughly 11 to 18 days per year on average. The continuous demand from urban renters keeps vacancies tight. Single-family houses, especially those in suburban and exurban markets, can experience significantly higher vacancy periods. When a family tenant leaves, and family tenants often vacate due to major life events like job changes, school transitions, or home purchases, finding a replacement can take 30 to 90 days. Houses need to be fully cleaned, repainted, and sometimes renovated between tenants. The timeline from vacancy to reletting is simply longer for houses. However, there's a critical counterpoint. Houses that attract long-term family tenants often have dramatically lower tenant turnover. A family that puts their children in the local schools and builds community ties may rent the same house for 5, 7, or even 10 years. Zero vacancy for a decade is the single best outcome in residential investment. The key question for investors is, are you optimizing for low vacancy rates through tenant diversity or low turnover through deep tenant commitment? Condos win on vacancy rate. Houses can win on turnover when the right tenant is in place. Leverage, using borrowed capital to amplify returns, is where the financial sophistication of real estate investing becomes apparent. And the two asset types have meaningfully different financing dynamics. For single-family homes, conventional financing is straightforward. 20% down, 80% mortgage, standard 30-year terms. Lenders love single-family homes because there's always an owner-occupier buyer pool as a backstop, making collateral risk low. In practice, sophisticated investors use BRRRR strategies, buy, rehab, rent, refinance, repeat, to pull equity out of houses and redeploy capital into additional properties. The land component of a house creates real collateral value that lenders understand intuitively. Condo financing is more complex. FHA and conventional lenders impose strict requirements on condo buildings. The HOA must be financially healthy, owner occupancy ratios must meet thresholds, and the building can't have pending litigation. Some older condo buildings become non-warrantable, meaning only portfolio lenders will finance them at higher interest rates. Additionally, as you accumulate multiple condo investment properties, financing becomes progressively harder. Banks typically cap investment property loans at 4 to 10 properties, depending on the lender. Houses have a slight edge on financing flexibility and leverage deployment, particularly for sophisticated investors running portfolio strategies. Houses win on leverage and financing. Tax advantages are a critical but often ignored component of real estate investment returns. And both asset types offer compelling tax benefits, with some important differences. Both condos and houses benefit from the same core real estate tax advantages. Mortgage interest deductibility, depreciation deductions over 27.5 years, and the ability to defer capital gains through 1031 like-kind exchanges. These apply equally to both asset types and are among the most powerful wealth-building tools available to individual investors in the U.S. tax code. Where they differ is in depreciation strategy. Houses have a higher land-to-building ratio, and land cannot be depreciated. In many suburban markets, land represents 20 to 30% of the total value, meaning only 70 to 80% is depreciable. Condos have a lower land component. The land value is shared across all units in the building. Per unit, your depreciable basis is often a higher percentage of purchase price, generating more depreciation write-offs annually. A $400,000 condo unit with 90% depreciable basis generates $13,090 in annual depreciation. The same value house with 75% depreciable basis generates $10,909. That's an extra $2,000 in annual tax deductions, compounded over decades. For high-income investors who can use depreciation to offset passive income, condos have a slight tax efficiency advantage. Condos win on depreciation efficiency, tax treatment otherwise equal. Liquidity, how quickly you can sell, is often overlooked by investors until they need the money. And condos have a meaningful advantage here. Condos attract a larger pool of buyers. First-time buyers priced out of houses, downsizing retirees, urban professionals, investors looking for rentals, all target condos. The buyer pool for condos is genuinely deeper than for houses in most urban markets. In practice, Well-located condos in major cities sell in 30 to 60 days on average. Houses in the same cities, especially those requiring renovation or located in car-dependent suburbs, can sit for 90 to 180 days. The exception is during market downturns. In a credit crisis or oversupplied condo market, condos can become illiquid quickly, especially if lending restrictions tighten for buildings with high investor ratios or deferred maintenance. Houses in prime locations tend to hold value and liquidity better during downturns because the owner-occupier buyer pool is more stable. In normal market conditions, condos are more liquid. In crises, houses may be more defensible. Edge to condos in normal conditions. So what's the verdict? After analyzing 7 key metrics, the data delivers a clear answer, but with important nuance. Condos win on purchase price, rental yield, management burden, and liquidity. Houses win on capital appreciation and cash flow in suburban markets. Maintenance costs are roughly equivalent. If you're an investor with limited capital, prioritizing cash flow, passive management, and a diversified portfolio, condos are the smarter starting point. Buy in a high-demand urban market with a quality HOA, and you'll earn a solid yield with minimal operational burden. If you're building long-term generational wealth and can afford to hold for 20 to 30 years, houses win. The land appreciation compounds powerfully over decades. The ideal portfolio? Both. Use condos for yield and cash flow in your early wealth-building phase. Add houses for appreciation and equity as capital grows. The investors who do best long-term don't pick sides. They understand which asset wins in which market and at which stage of the investment cycle. If this breakdown helped you think differently about real estate investing, hit subscribe and the notification bell. We publish new data-driven property analysis every week. Drop a comment below. Are you team condo or team house? See you in the next one.